Day Trading 101 How to Day Trade. Written by Aidan Botha. Narrated by Blythe Moline for Hot Ghost Productions. Introduction. The markets are all rigged. Everyone fails. You have to be an accountant with a ton of money. It's the equivalent of gambling away all of your money. Sound familiar? Whether you've heard it from your parents, professors, friends, or coworkers, there seems to be a plethora of myths and misconceptions residing in the minds of countless potential day traders. So, before we delve into what day trading is and how to become a successful day trader, we first need to dispel any myths or misconceptions swirling around through your mind, inciting unwarranted fears about your decisions to venture into day trading. Myth 1. Most, if not all, day traders fail. This common myth discourages all too many potential day traders from day trading. The assertion that a good majority of trading success estimates, i.e. 85% of traders fail, is based on anecdotes, not facts. Although day trading is considered a challenging career, success is possible, and you can succeed in this profession with a strong work ethic and the proper tools of the trade. Myth 2. The markets are all rigged. This is another discouraging myth that has no basis in fact. This conclusion is often drawn from people who gain access to minute fragments of highly provocative information, i.e., learning about high-frequency traders' roles in the financial market. In reality, even if the markets were rigged, which they're not, it wouldn't actually matter because each individual trader alone controls his or her own trading positions. Myth 3. It takes a ton of money to trade. Although varying markets have varying capital requirements for trading, these are limitations for day traders, not barriers. You can trade with less than $25,000. At this level of trading, there would be a limitation on the amount of traders permissible each week, which might even serve as a benefit to you. You're still able to build your portfolio with limited capital. Myth 4. Trading is equivalent to gambling. Trading and gambling have similarities, but they are not the same. Quote, traders have more control over the probabilities of their wagers because certain setups have a higher likelihood of winning than losing. End quote. Investors Live, 2019. Gambling odds are fixed while trading odds are flexible, since traders are able to make more informed wagers given their access to relevant information concerning their wagers. Now that we've addressed some of the most common myths regarding day trading, let's discuss what trading is. Day trading is the process of buying various financial instruments, i.e. stock, options, futures, currencies, etc., that are intended to be sold soon thereafter, usually within the same day, for a profit. The profit is the difference between the purchase price of the final instrument, i.e. buying 1,000 shares of stock for $3,000 at 10 a.m., and the sell price, i.e. selling the same 1,000 shares of stock for $3,500 at 10:15 a.m. As exhibited above, day trading can be an extremely lucrative career, a major draw for anyone looking for a career with enormous earning potential. Yet, earnings potential is only one of the many benefits day traders are awarded. Day traders are also able to be their own bosses, command their own schedules, and reap all of the benefits of their hard work. Day traders also get to enjoy the euphoria that comes along with conquering their goals and rewarding themselves accordingly. Furthermore, successful day traders achieve a certain degree of status that almost seems mythical. And the introduction of online financial markets made available by the internet has opened the doors to trading platforms for many newcomers to day trading, making it a great time for you to jumpstart your career as a day trader today. This book will give you the framework to propel you towards becoming a successful day trader. It includes the basics of day trading types and strategies, the rules and principles of day trading, benefits and risk of day trading, stock evaluation guidance, an introduction to technical analysis for day traders, the basics of swing trading, the logistics of day trading, a day trading survival kit. This book will provide you with a comprehensive inside look into the profession of day trading as a whole. Let it serve as your user's manual to day trading. Chapter 1. What is day trading? Before letting your most optimal day trading aspirations inspire you to invest your life saving into your first stock, it's time to map out your road to success, an essential step that should be taken before entering the market, whenever possible. So to begin, let's address a few key questions that should first be weighed when considering transitioning into day trading for a living. 1. Do you love stock? 2. Are you ready to make the transition into day trading for a living? 3. Is your stop-loss plan in place? 4. What's your plan for transitioning? And 5. Does it all add up? Do you love stock? Whenever considering a major life adjustment such as a career change, it's important to ask yourself why you're making the move. In the case of transitioning into making your living as a day trader, knowing why you're choosing day trading will keep you motivated in the beginning and continue to serve as a benefit throughout your career. And although enjoying the freedom and flexibility of working from home is a major perk for day traders, the pertinent question you should be considering when assessing how much you can expect to enjoy a profession in day trading are: do you enjoy being mentally stimulated throughout the day with a job that is as challenging as it is rewarding? Do you find value and enjoyment in watching the stock markets on the daily? Does strategic trading on the market for financial profit present a welcoming challenge for you to wake up to every morning? Can you test and refine different trade strategies to fit market shifts? If none of the above considerations struck gold for you, then it's time to ask yourself, why are you considering day trading? Although it's a great option for anyone wishing to work from home, the challenges that day traders face don't make it a recommended career move for anyone who doesn't find value and enjoyment in stock or the financial markets. Quote, being attracted to only the fringe benefits is a trap that catches many people. There is real challenge involved in trading for a living. End quote. Doe, 2019. However, if you do find value in the benefits of working from home along with any of the above points, then day trading can be a highly rewarding and profitable career path for you. Are you ready for the transition? Not only are there many considerations to weigh when making a major life adjustment such as a career change, as stated above, but a career transition into day trading is a major change in itself. You do yourself a serious disservice by failing to prepare yourself for the move, especially if you're going from a steady source of income to the unstructured financial world of day trading. Thus, you shouldn't rush to jump in feet first until you're absolutely ready. In order to determine how prepared you really are, ask yourself, what are my monthly expenses? What outstanding debts do I have? How much do I have saved? Will my day trading performance cover my current expenses and debts? Will this transition impact my credit positively or negatively, if at all? Will this career change have an impact on any potential job prospects? Will my family be affected by this adjustment? Is becoming my own boss a move I'm mentally and financially prepared to do? Addressing these questions before committing yourself to a life as a day trader will afford you a smoother transition and allow you to focus your energy on performing well in the financial markets. Is your stop-loss plan in place? Having a stop-loss plan in place is one of the most essential preparations you can make before becoming a full-time day trader. A stop-loss plan prepares you to transition into day trading with the assurance of a backup plan. It establishes the amount of money you are willing to lose in one day before calling it quits for the day. It can also include a secondary backup plan to grant extra security while transitioning into day trading full-time. For example, a banker with $65,000 in liquid assets along with a net income of $3,500 a month decides to give her job her 2 weeks' notice before becoming a full-time day trader. She has been studying the stock market for fun over the past 2 years and is ready to make it her bread and butter. Although she understands her net income will decrease during the transition, she expects to make more income overall once she is fully focused on day trading. She's also leaving her employer on good terms, so she can enjoy the convenience of returning to her employer. At the very least, she can count on getting a letter of recommendation for another potential employer, if she decides to no longer want to day trade full-time. Her stop-loss plan offers her a comfortable cushion for her to transition with ease and a backup plan in place. Like our banker, you too must be sure you have your plan in place before you make your transition into day trading for a living. What's your plan for transitioning? Now that you're ready to make the transition into day trading, it's time to put your transition plan into place. Whether you're transitioning from office to home or from employee to becoming your own boss, it's important to establish your work practices and principles from the start to ensure a smooth switch into your new life. Decide where you're going to work and set up your office or work area. Make sure you have your desk, computer, internet access, and anything else you may need to perform well on a daily basis. Set your hours and minimize your distractions. Does it all add up? After assessing your love level for trading, readying yourself for the transition, and putting both your stop-loss and transition plans into place, the final question you should ask yourself before committing to life as a full-time day trader is, does it all add up? That is, quote, do the profits from trading cover your living expenses with a margin for volatility? End quote. Doe 2019. A trader's ability to save funds in order to execute a potentially profitable strategy should also be taken into consideration. For instance, Stephen is a day trader with $50,000 in savings and around $15,000 a year in expenses after reducing his monthly expenses to $1,250 a month in preparation for his transition into full-time trading. He is working with a mentor who expects Stephen's trading to start yielding a profit after his first year. This leaves Stephen with a buffer of about $35,000 during his first year of full-time trading, assuming he's able to cover his expenses whether or not he makes a profit at all during that year. Thus, making the transition into full-time trading adds up to a good move for Stephen to make, given his circumstances. Like Stephen, you should be sure that all of the elements of your current situation support your move towards day trading for a living too. Basics of day trading. Whether your vision of day trading is reflective of the original movie Wall Street from 1987, the 2010 sequel movie Wall Street, Money Never Sleeps, or the actual crashes on Wall Street from 1929 or 2008, it's time to refresh your own internal stock memory for the second decade of the current millennium. For this refresh, we'll be replacing your memories of brokers only succeeding at major trading houses and large financial institutions with the online world of today, full of individual investors making their living by trading online. We'll also be whipping out any misconceptions you may have about day trading being the same as investing. Investing, quote, is the process of buying a stake in an asset that will hopefully build a profit over the long term, end quote, Harris 2019, which could run from a few years to several decades. Further, investors are usually individuals concerned with investing in companies that can yield solid profits, clearing their debts timely, maintaining efficient pipelines of products, and are avoiding litigation. Hence, investing is not the same as day trading, but there are similarities. Similar to investing, day trading involves making sound investments to generate profits, but its activity takes place within a much shorter window of time. Day traders aren't afforded the years or decades of long-term profit that investors enjoy. Instead, their securities are both bought and sold on the same day, aiming to buy low and sell high. For instance, Trader Mackenzie starts her day with a 9 a.m. purchase of 1,000 shares of stock. Within minutes, the stock price starts to rise, so she sells it at 9:15 a.m. At the time of the sale, the stock price was up to half, 50 cents, so Mackenzie makes a profit of $500 minus the commission for the stock transactions, with commissions typically ranging from $7 to $27 on popular trading markets like Scottrade. That's a net profit ranging between around $473 to $493 from a single trade, and day traders generally make around 25 to 30 trades a day, boosting their earnings by maximizing their trading volume. As a result, a key reason day traders don't hold stock overnight is to minimize their risk, as stock prices are prone to drastic changes from day to day. Day traders also make it a point to stay updated on events that may affect the market and incorporate various intraday strategies to perform well during sudden market shifts. Benefits of day trading. In addition to great earnings potential, day trading offers several advantages for those emotionally mature enough to perform well amidst the inherent pressure infused in the financial markets. These benefits include independence. Many day traders of today enjoy the privilege of being their own boss, dependent on their own wits and, optimally, realizing all of the benefits from their own choices and hard work. They enjoy the flexibility of working and earning based on their own demands and expectations, as well as the freedom of commanding their own calendar, enjoying the leisure time as they deem fit. Status: Warren Buffett, George Soros, Jeff Bezos. The market's top performers not only see major profits but also attain major status. Day traders occupy an almost mythical status in certain communities, similar in many ways to the legendary fast guns of the Old West. Iconic outsiders, living by their own rules and making their own ways. Lewis, 2018. Euphoria. Although the joy of reaping a major profit is a celebration in itself, the emotional high that comes along with yielding a profit from the singular fruits of your own labor is one of a kind. Difficulties of day trading. As rewarding a career as day trading may be, it doesn't come without its own risk and difficulties. These include both financial and psychological risk. Profit potential. Often erroneously, only considered a benefit. Quote, the profit potential of day trading is perhaps one of the most debated and misunderstood topics on Wall Street. End quote. Cooper, 2019. Although the internet has opened the doors for many newcomers to trading, it also opened the doors to many novices lacking sufficient knowledge to succeed and scammers promising major returns in short turnarounds. Capital loss. While day trading may be a highly profitable career, the upfront cost to get started can add up. Day trading requires software, hardware, news services, and capital to begin. Then, to maintain your practice, additional expenses are incurred, such as the cost of real-time news feeds, commission fees, communication charges, financial analysis, and charting packages. Market movement. The market can feel like Christmas on Tuesday and Black Friday by Wednesday. A trader arriving late on the market could change a potential profit into a major loss. When there are too many traders in the market but only a few viable options, only the early birds to the stock are likely to fill their bellies with worms in the form of profits. Psychological addiction. Poker players are aware of the risk of addiction that come along with the thrills of gambling. So, if you relate poker addiction to that of a major substance like alcohol or cocaine, trading addiction might be considered the crack of gambling addictions. Quote, some psychologists suggest that gamblers and day traders are similar in that they tend to be competitive and of above-average intelligence. End quote. Lewis, 2018. Is day trading for you? Deciding whether day trading is right for you requires major consideration because it's a challenging career that comes with both risk and reward. Many successful traders advise new traders to begin with a minimum of $100,000 in capital. Thus, a lot of newcomers of day trading start with either too much capital or seek employment at major trading firms until they have enough capital to venture off on their own. Whatever your philosophy, the following tools are essential to all day traders wishing to succeed. 1. Infrastructure. Today's traders utilize a range of technology, including computers, monitors, internet, specialized software, trading services, an electronic communication network, ECN. Having your own proper infrastructure in place is key to performing well in the market. 2. Substantial capital. As stated above, experienced day traders suggest beginners start with at least $100,000 in capital. However, capital requirements differ for varying markets, so the capital needed will also be dependent on the markets the trader operates in. Additionally, other considerations are needed for day traders considering short selling. In order for day traders to engage in short selling, a margin account is required. Short selling is when traders sell stock they don't own in order to hold it under the anticipation that the stock price will drop. The theory behind short selling stock is that the trader assumes unlimited risk given the stock price has no ceiling on its increase before the trader is able to cover it. Conversely, there is an inherent limited risk in purchasing the stock, given the stock price can never decrease below zero. Margin accounts for day traders are like lines of credit. The margin account holds the cash or value of stocks that are loaned to traders in order to acquire or maintain their positions. 3. Knowledge. Although traders deal with a number of companies with varying interests, it's not the company's fundamental values that concern the traders. Fundamental values don't generally impact a company's stock price on the market. However, the hopes and fears of a company's individual shareholders are a concern to traders because it can be measured in the psychology of the market as these individual shareholders buy and sell. Thus, traders hone in on indicators reflective of individual shareholders' feelings, often utilizing professional charting services and sophisticated software for analyzing real-time data. 4. Experience. Learning to become a successful day trader may be comparable to earning a college degree because it can take just as long. Couple that with the risk involved, and you'll likely end up with a suggestion many traders recommend for newcomers to the trade. Start off with paper trading. Paper trading involves making imaginary buys and sells using actual market data, but without risking real money. Lewis, 2018. It allows beginners to identify opportunities for profit while also learning the mechanics of the financial market. Several brokers offer beginners virtual accounts to facilitate paper trading. 5. Discipline. As mentioned earlier, day trading may be considered the crack of gambling as far as addiction is concerned. Hence, traders should remain cautious of growing addicted to the marketplace. Many day traders find themselves addicted to the action of the market, not the earning potential. Traders addicted to the action crave the adrenaline rush felt by winning, but will often lose as many times as necessary just to feel the adrenaline of that one win. The, quote, link between trading and gambling is so strong that Gamblers Anonymous has a general rule that members should hold stock for at least 18 months, if they invest in stocks at all. End quote. Lewis, 2018. Traders should remove their emotions from their trades and develop a firm set of rules to abide by in order to become successful at day trading. 6. Time commitment. Not only is day trading a full-time job, but successful traders often put in overtime. Day traders can easily work 60 to 70-hour work weeks, and that's not including the nights spent preparing for the next day of trading. Identifying potential profits is a never-ending job requiring an unlimited amount of time. Are you still eager to become a day trader now that we've covered the basics, addressed the pros and cons, and considered whether a career in day trading is right for you? If so, the rest of this book will equip you with the strategies, rules, principles, and best practices to facilitate your success as a day trader. Chapter Summary. In this chapter, you learned the basics of day trading, the benefits and risk of day trading, how to determine if day trading is right for you. In the next chapter, you will learn day trading types and strategies. Chapter 2. Day trading types and strategies. As with any industry, there's more than one way to perform well as a day trader. Day traders have a variety of trading styles and strategies available to them to suit their individual personalities, including short-term trading styles like scalping, as well as long-term trading styles like swing trading. The various styles and strategies are not only available to cater to varying trading personalities, but also to various positions. Thus, it's not unheard of for day traders to utilize multiple trading styles throughout the day. However, it's more common for most traders to opt for a particular style of trade and stick with a singular trading style. Just the same, most day traders typically choose a particular style of trade and stick to it, while others choose to diversify their options and base the type of trade they choose on market conditions. Day trading types. Quote, whether trading stocks, futures, options, or effects, traders confront the single most important question: to trade trend or range. End quote. Schlossberg, 2019. The answer to this question lies in serious scrutiny of the price environment. The better the analysis of the price environment, the greater the trader's odds for success. These two types of trades are not only distinct in price, but in trading personalities and financial management techniques too. Financial markets, such as the FX, are able to accommodate both types of trade. Given the fact that trend trading leads the popularity pack between the two types of trades, we'll examine this type of trading first. Trend trading refers to a trader's ability to identify an equity's trend. In this regard, trend may either be defined as a divergence from a particular range or an upwards or downwards price movement. The trend of a particular stock may be spotted a number of ways, including simply eyeballing a trend, as well as the use of moving averages. When traders use the eyeballing method, they may use a daily, weekly, or monthly chart displaying the stock under scrutiny to identify how both peaks and valleys are charted for the stock to determine whether it's on an uptrend or a downtrend. An uptrending stock will reflect charts with a series of higher highs and a series of higher lows in between, similar to a staircase effect. Conversely, a downtrending stock will exhibit charts with a series of lower highs with a series of lower lows in between, akin to an inverted staircase and reflective of a trend on a downward slope. Moving averages are another common method traders use to pinpoint an equity's trend. Similar to using the eyeballing method, traders watch price movement averages throughout a specific period of time for a given stock, basing their calculations off of the given stock's historical performance. In addition to reflecting on equities' historical performance, the method is also a useful measure for projecting the future direction of a given stock. For instance, a trader who uses a moving average on an intermediate or long-term trajectory and identifies an equity on an uptrend may come to the conclusion that the equity will continue progressing even higher along that path. However, traders should be mindful that, quote, when using moving averages to spot a trend, the more times a supportive moving average is tested, the weaker it can become, end quote. Schaefer's 2019, and vice versa. Trend traders often focus on a singular question: am I right or out? This question is predicated on the trend trader's inherent notion that the price movement will continue trending in its current direction, which would make the trader right. On the contrary, a price movement that doesn't continue trending in the same direction is less optimal for traders, garnering little justification to hold on to the equity, making the trader opt out. Hence, trend trading requires considerable risk control and yields significantly more losses than gains. Based on this average, it's generally recommended for traders to reduce their risk by limiting their trend trading budget to no more than 1.5% to 2.5% of their total capital of any individual trade. While trend trading is the most popular between the two types of trends, trading range remains another viable option that many traders prefer. Also known as the sideways trend, trading range refers to an equity that fails to reflect a definitive uptrend or a downtrend, only presenting slight movements in either direction with no clear trend. Consequently, trading range could mean dealing with an equity that trends upward 5% on Monday but ends up losing 1% each day for the rest of the week, ending where it began. Thus, trading range can sway either way, presenting both risk and advantages. A risk traders face with range trading includes stocks that fall victim to year-long languishes between contradicting channels of support and resistance. Whether the channel be arbitrary, represented by moving averages, or represented by round numbers, they typically contain equities incapable of gaining enough momentum to sway their trading range towards any definitive trend. This results in the equities often being disregarded as range-bound stocks. On the positive side, a stock on a sideways trend may be trending sideways during the period of consolidation right before trending upward. This often occurs, quote, when an equity is gapped above support from an intermediate or long-term moving average, end quote. Schaefer's 2019. In this case, a given stock will trend sideways as it bridges the gap between its movement. Once the stock's trend line is caught up to its respective movement, the moving average subsequently propels the stock upward with an avalanche of support. Despite the sporadic price movements presented by range trading, the direction of the movement is actually of little concern to experienced range traders. The origin of the price movement is of more importance as it is likely to return to this point no matter how many levels of up or downward sloping trends it travels through. Consequently, range traders often utilize highly efficient financial management techniques, often preferring being wrong entering a particular trade and refining their positions accordingly for optimal performance. Strategies of day trading. With day traders averaging 20 to 30 trades on any given day, a range of strategies are needed to perform well during the shifting trends of their varying stock positions. Staying aware of any news regarding their trades is a common practice. Financial markets react to a number of factors on any given day, including both anticipated and unexpected announcements regarding interest rates, economic statistics, and corporate earnings. These factors have a direct impact on market expectations and psychology, offering opportunities for day traders to base their trades off of sudden trend changes and incorporate a variety of intraday trading strategies to perform well and maximize their earnings. Some of these strategies include 1. Position trading, 2. Swing trading, 3. Scalping, 4. News-based trading, 5. High-frequency trading or HFT, 6. Arbitrage, 7. mergers and acquisitions. Position trading. Sometimes relegated as more of a buy and hold strategy than a form of active trading, position trading relies on the use of long-term charts, typically ranging from days to months, in tandem with other available methodologies to track price movements of a given equity. Thus, traders who employ position trading strategies seek to hold their stock positions over a longer period of time, sometimes spanning into years. In that regard, investments are prime examples of position trades, and it's not uncommon for many position traders to contain long-term investments listed in their portfolios. However, whereas investments are restricted to long-term positions, position traders also seek out short-term positions. With position trading's primary focus being long-term positions, it is often regarded as the opposite of day trading. While the focus is on long-term positions, the goal of position traders is to, quote, identifying trends in prices of securities which can continue to relatively long periods of time and earning profits from such trends. Generally, position trading may provide lucrative returns that will not be erased by high transaction cost. End quote. Corporate 2019. As is the case with all forms of trading strategies, there are risks associated with position trading. Two of the most common risk position traders encounter are low liquidity and trend reversals. Low liquidity risk refers to when traders find themselves locked into a particular position for significantly longer time periods than originally anticipated. Trend reversals have a more direct impact on a trader's capital. When trend reversals occur, traders usually realize hard-felt losses due to sudden price movements in the opposite direction. However, position traders are able to utilize fundamental and technical analysis to minimize their risk to the best extent possible. Swing trading. Swing traders seek out shorter-term market positions than position traders. Their focus is optimizing on price volatilities identified by breaks in trends. These opportunities are usually presented at the tail end of a trend when the incoming trend is trying to establish itself, presenting price volatility. Swing traders take advantage of this volatile time and buy or sell during this establishment period. They, too, rely on technical and fundamental analysis to frame their established set of trading rules or algorithms. Swing traders design these rules to determine the most opportune time to buy and sell. Swing traders will be discussed in further detail in Chapter 6. Scalping. Scalping holds the crown for the quickest strategy available for day traders to employ. This strategy involves capitalizing on numerous price gaps created by order flows and bid-ask spreads, which is essentially, quote, the difference between the highest price that a buyer is willing to pay for an asset and the lowest price that a seller is willing to accept, end quote. Gonti 2019. With this strategy, scalpers aim to buy in at bid price and sell said trade at ask price, maximizing their profits between the difference. As a result, scalpers tend to opt for liquid markets, using smaller but frequent moves, moving smaller volumes more frequently, and prefer less sporadic financial markets with sudden fluctuations in price movement. This method allows them to continuously replicate their spreads on identical bids. News-based trading. As previously stated, traders rely on news updates that relate to factors that may have an impact on their positions. So it's natural for day traders to utilize news-based trading strategies. Because if they are prime factors monitored by traders in relation to their effect on price movement, price volatility and volume, news-based trading allows traders to exploit temporary mispricings of a given equity and capitalize off of it. With news-based trading, the mispricing of a particular security is often the result of news and/or events that have yet to be reflected in the price of the equity. This news or event could be anything from a release of a security's quarterly report to a sudden corporate takeover or merger. Similar to methods available to swing traders, news-based traders also have the advantage of being able to employ algorithms to help them perform well on their positions, which is considered algorithmic news-based trading. Algorithmic news-based trading relies on algorithms to help traders with interpreting news. Traders compile news-based articles focused on certain keywords to assess the data, determine the collective meaning and importance, and frame their trades based on the results. Since the essence of trading is the news that supports it, one of the most significant elements of algorithmic news-based trading is evaluating relevant news articles. In order to achieve this evaluation, scores are assigned by the algorithm to each news report, allowing the elemental position to be interpreted as either positive, negative, or neutral. In addition, the evaluation also accounts for relevancy and sources each article based on the keywords assigned. News-based traders also have to utilize efficient risk management techniques while trading on financial markets. Its reliance on keyword searches results in traders running the risk of incoming news not fitting their predefined searches. This results in important data not being identified and evaluated, leading to inaccurate scoring and erroneous trading. High-frequency trading, HFT. High-frequency trading, or HFT, is one of the more controversial strategies available to traders. Although there is no formal definition for HFT, it's commonly regarded as a method to trade at record speeds by way of preset algorithms that are run through designated computer programs. Despite not having a formal definition, the Securities and Exchange Commission (SEC) has prescribed certain characteristics as being common to the practice of HFT. Positions representing significantly short time spans for establishment and liquidation, trading with sophisticated software designed for processing orders at extremely fast speeds, myriad order submissions that get canceled shortly thereafter, minimization of network and latencies by utilizing individual data feeds and co-location services available, refraining from holding prevalent, unhedged positions past the close of the trading day and aiming to close at the closest flat position possible. Some contention raised regarding HFT are that it allows traders to exploit fleeting opportunities and misconstrues the market. Yet, HFT's ability to enable traders to make trades at what seems like lightning speed, around 64 millionths of a second, presents earning potentials that can't be ignored. 3 advantages in particular lead the pack. 1. Volume trading. Utilizes a system that enables trading at volumes deemed impossible for manual traders. Automation allows a yield on profits for the most minuscule of price differences. 2. Short-term opportunities. Traders are able to take advantage of short-lived opportunities that vanish quickly on financial markets. Timely traders are awarded the added advantage of capitalizing off of said opportunities before the security begins trending. 3. Arbitrage. Allows traders to exploit one security with varying prices. Given the rarity of these trades, HFT presents more opportunities for traders to identify them. Arbitrage. Arbitrage is not only an opportunity presented through HFT as stated above, but also a strategy in itself. Again, arbitrage is a strategy traders use to make advantageous trades on one equity that has 2 prices. For instance, City C sells water for 89 cents per bottle, while City D's water sells for $1.09 per bottle. Trader Janet identifies it as an arbitrage opportunity and buys 1,000 shares of water from City C to be sold in City D at the inflated price. As previously noted, arbitrage opportunities don't present themselves often to traders. The reason for this rarity includes advancements in technology that have equipped global information networks designated for financial markets with practical real-time global updates and enhanced reliability. For another illustration, let's assume that the financial market in New York City takes approximately 0.45 seconds to update and reflect that of London's market. That time differential presents less than half a second in which the euro can sell for a higher price in New York City than it does in London. As short of a time frame that might seem, it's plenty of time for a computer to process volumes of shares, allowing a trader to purchase millions in euros from London to sell at an inflated price in New York City. That's an example of the earnings potential arbitrage opportunities present. Mergers and acquisitions. When 2 companies join forces, a merger occurs. Acquisitions, on the other hand, is when large companies acquire smaller companies outright. Companies engage in mergers and acquisitions for a variety of reasons. Buying out competitors is a prime example, such as when Facebook paid around $1 billion to acquire Instagram, now worth over $100 billion. Or when Google paid $1 billion to acquire YouTube, which is now worth over $200 billion. Creating synergy is another reason companies engage in mergers and acquisitions. For instance, pharmaceutical company A has 2,500 employees, while pharmaceutical company B has 1,500 employees. If both companies merge, they can consolidate that workload to 2,500 employees, creating synergy while producing the same output with less overhead. Companies also engage in mergers and acquisitions in an effort to accelerate growth. Facebook offers another good example for this objective. Not only did Facebook acquire Instagram, but it also acquired the popular messaging application WhatsApp. Both of these acquisitions were made when Facebook realized that its legacy platform would start seeing reduced growth. To accelerate its growth, it acquired Instagram and WhatsApp. It also sought to acquire Snapchat before it became a public company. Day trade the world, no date. For traders trading based on mergers and acquisition news, the strategy is, quote, to go long on the company being acquired and shorting the one doing the acquiring. End quote. Day trade the world, no date. IBM's acquisition of software company Red Hat is a prime example. When the financial markets closed on Friday, the trading price for Red Hat was $116, and IBM acquired Red Hat at $190 per share. Since IBM has cemented the trade at $190 per share, Red Hat's equity will rise to $190 per share, while IBM's will trend downward. This market psychology is based on investors' likelihood to dilute and move their money to other opportunities, the inherent risk of IBM's debt increasing as a result of the acquisition, and history statistics suggesting mergers and acquisitions don't typically work out as planned. Thus, traders should go long on Red Hat, the company being acquired, and short IBM, the company doing the acquiring. Understanding the strategies available to employ on the financial markets is essential to performing well as a day trader. But it's only one part of the equation. Setting a proper foundation with the proper rules and principles is also key. And realizing the risk involved with day trading is also vital. So before venturing out and trying your hand in one of the strategies you've just been equipped with, we'll start building your framework. Chapter Summary. In this chapter, you learned the basics, benefits, and difficulties with day trading, the difference between trend trading and trading range, different strategies day traders employ to perform well on financial markets. In the next chapter, you will learn the rules, principles, and risk involved with day trading. Chapter 3. Rules and Principles of Day Trading. Just as banking institutions are bound by certain rules and regulations pertaining to their management of the funds entrusted to them, financial markets are governed by rules that day traders are expected to adhere to, whether trading futures, options, stocks, cryptocurrency, or forex. A trader's failure to abide by an applicable rule could prove to be considerably costly, so it's best to be aware of these rules before finding yourself on the costly end of a broken one. Since trading rules are dependent upon location and volume, we'll explore a few of the most primitive rules day traders are subjected to, including rules advantageous to both beginning and experienced traders aiming to improve their performance. Pattern day trading rules. For traders residing in the USA, a major concern is whether or not you are a pattern day trader, or PTD. PTDs who hold margin accounts are subject to the Financial Industry Regulation Authority's FINRA rules and stipulations. FINRA rules govern trades both under and over $25,000 in the NASDAQ and other relevant markets. To determine whether or not you qualify as a PTD, the following criteria has been set. Traders who trade over 3-day trades within 5 business days, and the number of said trades is in excess of 6% of total trades in the trader's accounting period. Given PTD criteria is dependent on the number of trades a trader makes, understanding what constitutes a trade is imperative. While a day trade is considered as being the practice of making 2 trades in the same financial instrument within the same trading day, PTD stipulations require that the 2 transactions have to offset one another to constitute as a trade. Thus, any trades held overnight do not qualify. In addition to being mindful of what constitutes a trade for PTD requirements, traders should also be aware that the volume of trades can prove confusing and result in costly errors. So the appropriate clarity should be sought whenever confusion arises as to ensure proper adherence to PTD rules. The rules PTD traders are required to adhere to are as follows. 1. Minimum account balance. PTDs must maintain a minimum account balance of $25,000 without cross-guaranteeing separate accounts. However, combining eligible cash and securities to meet this requirement is permissible. 2. Existing sale conditions. Existing sale positions from the previous day are not considered day trades. including their subsequent purchases. 3. Buying power. By the previous day's close of business, PTD's trading power must be 4 times the New York Stock Exchange's NYSE's excess, allowing for the time and tick method for calculating day trading. Margin calls will be issued if this limitation is exceeded. 4. Outstanding margin call. Accounts with outstanding margin calls will result in their buying power being reduced by half, only 2 times the NYSE excess, and the time and tick method for calculating day trading will be prohibited while the margin call is outstanding, allowing for the aggregate method of utilizing all-day trades instead. 5. Failure to meet margin calls. PTDs who fail to meet a margin call for additional funds within 5 business days will have their buying power reduced even further to only a multiple of 1 times the NYSE excess for a period of 90 days for cash trades until the margin call has been met. 6. Minimum requirements. Funds deposited to meet margin calls or minimum security requirements must remain in the PTD's account without withdrawals for a minimum of 2 business days. Wash sale rule. The wash sale rule is another important rule that day traders in the U.S. need to be aware of. This rule is regulated by the Internal Revenue Service, IRS, and prohibits traders claiming losses on for the trade sale of a security in a wash sale. Day trading rules, no date. A wash sale occurs when a trader trades a security at a loss while also purchasing a substantially identical security or option to do so within the 30-day period either preceding or following said trade. This condition also holds true if your spouse or a company under your control is the purchaser of the substantially identical security instead of you. When the IRS disallows a loss based on the wash sale rule, the loss has to be added to the cost of the new equity, making it the cost basis for said new equity. As an example, let's assume trader Jeffrey purchases 200 shares in Microsoft for $30 per share and sells them at $25 per share to yield a capital loss of $1,000. A month later, trader Jeffrey purchases 200 more shares at $27 per share, which is sold a week thereafter at $37 per share. To calculate the net loss, start with the $5,000 in sales proceeds, subtract the $6,000 used to purchase the original 200 shares, and then add the $1,000 for the adjustment, which yields a net loss of $0. To calculate the capital gain, add the disallowance of $1,000 to the $5,400 used to purchase the second 200 shares for a capital gain of $7,400 minus the adjusted cost of $6,400. Thus, trader Jeffrey would be better served from the $1,000 loss yielded from the wash sale if he reduces his gain on the second purchase of 200 shares by $1,000. Rules for beginners. In order to stay clear of costly trading pitfalls, newcomers to day trading should prescribe to the following 7 rules. 1. Know when to enter, exit, and escape. Having a game plan on that sets guidelines for when to not only get in on a trade but also get out is vital. This is where your stop-loss plan comes into play so you can maximize your profits and minimize your losses. 2. Timing is key. A rule of thumb is to allow the market to breathe during the first 15 minutes into opening. Much of the early activity is frenzy from the previous day, so you can use this time to identify any reversals. 3. Remain wary of margin. No matter how stringent your early capital restraints may be, don't let the margin sway you in the wrong direction. Remember that your capital is essentially a loan that must be repaid, so it's wise to avoid substantial losses. 4. Use demo accounts for practice. Demo accounts offer invaluable experience without the risk of losing capital. They allow beginning traders to develop their skills, and several brokers provide free demo accounts. 5. Don't be afraid to lose. All successful traders have losses in their rear views that left priceless lessons for them to reflect on. Losses come along with the learning process, but you should also learn how to mitigate your losses through risk management. 6. Take it all in. Traders should be continuous learners, in constant search for knowledge to enhance their edge and steer them clear from complacency. The markets don't remain constant, so neither should a trader's strategy. 7. Evaluate tips. No one likes to suffer the consequences of someone else's erroneous actions, and trading inspired by faulty or inaccurate information is no different. Furthermore, bad information can lead to considerable losses. You should rely on your own judgment first and foremost. But when you do get a tip that may influence your trading, triple check it for accuracy before making a move. Risk management rules. Your success as a day trader is not only dependent on the strategy you use, it's also strongly dependent on your risk management. Some risk management rules that may come in handy are 1% rule. Never trade over 1% of your total capital on an individual trade. This principle based on ensuring you never trade more than you're able to afford. When applied, this rule allows you to keep excess in your account to rectify your balance no matter how wrong a trade may go. With this principle, it may take 100 consecutive trades before your balance to be eliminated. Since it also limits your return on profits, this rule is considered to be more of a benefit to beginners than more experienced traders. Principal risk. The risk of losing your capital. Two of Warren Buffett's principal rules, quote, rule number 1, never lose money, rule number 2, never forget rule number 1, end quote. Justice 2017. Consider option contracts. It's insurance for your portfolio. Put option contracts give you the right to sell an asset at a set price, and it rises in value as the asset falls. Justice 2017. It also could reduce your principal risk by over 50%. 4 core principles of day trading. Not only is risk management a core rule for day trading, it's also one of the 4 core principles of day trading, which are 1. Risk management, 2. Cash flow, 3. Fundamental analysis, and 4. Technical analysis. Earnings potential is a big draw for day traders, but day trading and cash flow aren't typically assumed to go hand in hand for those unaware of the cash flow opportunities available in stocks and commodities. Stocks and commodities are often viewed as capital that is held for gain. However, both can be used as a monthly source of cash flow. Traders can apply option strategies to create this monthly cash flow. For instance, naked puts, also known as uncovered puts or short puts, is an option strategy involving writing or selling put options. With this strategy, traders are not obligated to hold a short position in the underlying security. Instead, traders operate under the presumption that the price for the underlying security will likely fluctuate in value. The sold option is said to be uncovered because the initiator has no position with which to fill the terms of the option contract, should a buyer wish to exercise their right to the option. Scott, 2019. Naked puts are designed to yield profits for traders capable of accurately forecasting the price drop for the underlying security. Thus, a price increase on the respective security will negate the naked put strategy because the option reverts to zero and the seller is able to retain the capital from the sale of the initial option. A covered call is another option strategy, available for creating cash flow with stocks and commodities. This strategy not only utilizes trades from the underlying stock, as naked puts do, but it also involves making trades on the options contract. With this strategy, if the trader isn't already the owner of the underlying stock, the trader can buy it and then sell call options. The call options are equal to or less than the number of shares held by the trader as they await the expiration of the options contract, or wait for the contract to be applied. If the option contract expires, the stock remains held by the trader. On the other hand, the trader gets to sell the stock at the strike price if the contract is actually exercised. When it's a covered call, the sold stock is usually out of the money, or OTM. This situation enables gains on the sale of the options contract as well as the underlying stock, given it's remaining below the OTM option strike piece. Fundamental analysis may be a core principle more relatable to everyday life. In fact, it's a core principle of day trading that you already partake in as a consumer with every purchase you make when you consider the price of an item against its value. It's similar to the real estate industry's property flippers, who look for properties they can buy at low prices to sell or flip for a profit. What we consider a value as consumers is what traders term as valuation on the financial markets. Fundamental analysis involves evaluating the value of a given company in order to determine if the market price offers traders good opportunities for trading. Just as house flippers do, traders aim to buy low and sell high when conducting their fundamental analysis. While financial analysis is needed for traders to evaluate what securities to buy, technical analysis is used to determine when traders should buy. To put it in technical terms, technical analysis involves an in-depth examination of price action. It includes any tool of the trade employed by traders to analyze price movements in the markets, making the umbrella covering what is considered a technical analysis considerably broad. Technical analysis will be discussed in further detail in Chapter 5. As you may have realized by now, day traders have a plethora of considerations to take into account while they perform on the market. Knowing the rules for the location and markets you're trading on is a big priority for avoiding costly mistakes. Understanding the core principles is key to honing your skills and enhancing your performance. Both objectives are fundamental parts of the foundation you need to set for yourself in order to succeed as a day trader. Now that the groundwork has been laid for your foundation, you can continue to build on it as your career grows. Chapter Summary. In this chapter, you learned the importance of setting a proper foundation for your career in day trading, rules for U.S.-based day trading, including rules for beginning day traders, and the 4 core principles of day trading. In the next chapter, you will learn how to evaluate stock as a day trader. Chapter 4. Evaluating stock for day trading. Another elemental objective for day traders is pinpointing stocks to focus their attention on. With so many different options available on a daily basis, pilfering through to identify the stocks that suit your goals and objectives can prove to be a daunting task. There is no uniform practice for all day traders to perfect in order to perform well, and choosing stock doesn't allow for cookie-cutter approach either. It should be based on each individual trader's situation. When considering stock, take into account your total capital, the type of investing you're most interested in, and weigh your risk tolerance. You'll also want to take advantage of any available discounts available for your market research. When conducting your research, study the financial markets, stay attuned to the financials of companies with securities you're interested in trading, analyze your personal values and needs, then identify sectors most reflective of those needs, get an early start on trading each day, refrain from developing emotional attachments to any given stock, and remain current on all news pertaining to your vested stock, including the economic calendar and all relevant earning seasons. Demystifying the stock market. In order to perform well as a day trader, you have to know what stock actually is. Also referred to as an equity, security, or share, a stock is, quote, a financial instrument that represents ownership in a company or corporation and represents a proportionate claim on its assets, what it owns, and earnings, what it generates in profits, end quote. Hayes, 2019. Stock shares can also attribute voting rights to shareholders, which can prove to be even more valuable. For the purpose of demystifying the stock market, we'll focus on the ownership equity aspect of stock. Owning stock or shares of stock in a company suggests that the vested shareholder possesses a portion of the company that's equivalent to the total number of shares purchased by the shareholder in proportion to the company's total outstanding shares. This means that if you buy 100,000 shares of stock in a business that has 1 million outstanding shares, your ownership stake is 10% of the company. In general, companies' outstanding shares typically run well beyond millions or billions. The 2 main types of stock traded in financial markets are common stock and preferred stock. Common stock versus preferred stock. When traders use the term equities, it's often synonymous with common stock or common shares. Common stock may be the more popular of the 2 main types of stock due to its ability to offer much larger trading volumes and market value than preferred stock. Common shares often come along with those extra invaluable voting rights that some stock offers its shareholders. This enables common shareholders to have a voice in the company, such as in corporate meetings during which board of directors are elected or auditors are selected. Preferred stock, on the other hand, doesn't typically offer its shareholders voting rights. However, it does have the advantage of having preference over a company's common shares when it's time to pay out dividends or liquid assets. That's why it's called preferred stock. Though voting rights are a major advantage presented by some common stock, ownership doesn't always equate to 1 vote per share held by a shareholder. In some instances, dual or multiple classes of stock are present that are subject to varying voting rights dependent on each class. For example, some stocks offer a dual-class structure that provides shareholders in Class A 10 votes per share, while shareholders in Class B are limited to only 1 vote per share. This arrangement enables the founding members of a company to retain control of the company's finances and strategic direction. Stock market versus stock exchange. While stock is the commodity day traders trade, the stock market is the arena where these trades take place. Although considered public venues for trading, it's increasingly common for traders to trade online nowadays at electronic marketplaces. The market is what actually establishes the share prices by way of the supply and demand of buyers and sellers placing orders on the financial markets. However, although traders are able to buy and sell company stock, it's important to note that the actual companies that are associated with the stock are not regularly engaged in the process of buying and selling their own shares of stock. Instead, the shares that traders buy and sell on the stock market are actually shares being bought and sold to other existing shareholders and investors. Although stock is classified in a variety of ways, market capitalization and sector are two of the most common classifications. Classification by market capitalization involves taking into account both the total market value of the stock and the respective company's outstanding shares. In order to determine market capitalization, you multiply the current stock price of one share by the company's total shares. Determining the stock classification is a less technical endeavor, as it's based on the industry standards set by the Global Industry Classification Standard, or GICS, which was developed in 1999 by MSCI and S&P Dow Jones Indices. It was introduced as, quote, an efficient tool to capture the breadth, depth, and evolution of industry sectors, end quote. Consisting of 4 tiers of classification, including 11 sectors and 24 industry groups, GICS makes tailoring trading portfolios based on investment preference and risk tolerance much easier. The 11 sectors included are 1. Financials, 2. Real estate, 3. Utilities, 4. Energy, 5. Healthcare, 6. Industrials, 7. Consumer discretionary, 8. Materials, 9. Communication services, 10. Information technology, and 11. Consumer staples. Sector classification is beneficial to investors because it allows them to design their portfolios in accordance with their investment preferences and risk tolerance. For instance, healthcare utilities and consumer staples may be more suitable for conservative traders wanting to reflect their need for attractive dividends and constituent stocks that support their income needs. On the other hand, more aggressive traders who don't mind the risk as long as it's warranted by the potential regard may be more inclined to venture into more volatile sectors like energy, information technology, or financials. Another common reference related to day trading is the term stock exchange. Contrary to what may be considered popular belief, stock exchanges don't own shares for trading. In actuality, stock exchanges are secondary financial stock markets used for existing shareholders to make transactions with potential buyers for their shares. While it's most typical to trade stocks through brokers, stock exchanges connect stock sellers and stock buyers. One of the primary benefits of stock exchanges is their function as markets for liquidating shareholdings. This liquidation begins when companies conduct initial public offerings, or IPOs, which is a process in which, quote, a company sells shares to an initial set of public shareholders, the primary market. After the IPO floats shares into the hands of public shareholders, these shares can be sold and purchased on an exchange, end quote. Harper, 2019. Further, the exchange serves as a tracking system for each stock, monitoring its behavior, price movement, and the flow of orders. This arrangement presents several benefits for trading. Establishing stock option plans necessary for attracting highly coveted employees is easier when publicly traded shares are available. Listing on the stock exchange represents readily liquid assets held by a company's shareholders. Companies are better prepared to raise additional funds as necessary because they can issue more shares. In regards to making acquisitions for considerations to be partially or fully paid in stock, the company is able to use the listed shares as said currency. The stock exchange offers listed companies considerably more marketplace visibility, which can result in increased market share price from the analyst coverage and increased demand of institutional investors. The benefits offered by stock exchanges result in more benefits yielded to large companies who go public than those that remain private. Yet, being listed on the stock exchange has its disadvantages as well. Companies are forced to attempt to outdo their quarterly earnings instead of being able to utilize their corporate strategy's long-term approach due to the emphasis on maintaining a short-term focus. Costs related to trading, reporting, and compliance are among the considerable costs associated with having your shares listed on an exchange. Companies run the risk of finding themselves limited with restrictions set forth by burdensome regulations. Investing in stock. The reason that stock is considered king, or at least amongst the kings, of capital gain is because studies support the practice of holding it. Quote, numerous studies have shown that, over long periods of time, stocks generate investment returns that are superior to those from every other asset class. End quote. Harper 2019. Stock returns are the derivatives of dividends and capital gains. The shareholder's share of a company's profit is a dividend. A capital gain, on the other hand, is the profit made from selling a stock for more than it was purchased. Capital gains are optimal for investors with a higher tolerance for risk who aim to knock their trading out of the park as often as possible. More conservative investors are more keen to opt for securities that can increase their portfolio income through distributions of dividends. Choosing stock to trade. When choosing stock to trade, two considerations that should also be taken into account are liquidity and volatility. As previously inferred, liquidity, quote, refers to how quickly an asset can be bought or sold in the market. It can also refer to how trading affects the security's price, end quote, Halls 2019. Liquid stocks tend to be cheaper because they are discounted more heavily than other stocks and generally easier to day trade. Furthermore, corporations with higher market capitalizations are more readily capable to generate buyers and sellers for the respective stock because the equity they offer is more liquid than that of businesses yielding lower market caps. Volatility serves as a benefit to day traders as well. The more volatile the stock, the better. A volatile stock is one in which the corporation that issues the shares experiences more deviation in its capital flows. Quote, while markets will anticipate these changes for the most part, when extenuating circumstances transpire, day traders can capitalize on asset mispricing. Uncertainty in the marketplace creates an ideal day trading situation. End quote. Hall 2019. Choosing stock is only a scary endeavor when you don't have the proper knowledge to make informed decisions about your trades. Knowing the basics such as research, common versus preferred stock, the stock market versus the stock exchange, and liquidity versus volatility plays a major part in making informed decisions as a day trader. They are all elemental contributing factors you need to take into consideration when deciding what stock options best suit your situation, goals, and objectives. Chapter Summary. In this chapter, you learned what stock is and the difference between common and preferred stock, the difference between the stock market and the stock exchange and how day traders trade on both markets, and how to choose stock that suits your situation, goals, and finances. In the next chapter, you will learn more about technical analysis. Chapter 5. Technical Analysis for Day Traders. Technical analysis is one of the 4 core principles of day trading for good reason. While the other 3 core principles, cash flow, risk management, and fundamental analysis, are essential for traders when considering stock options to trade, technical analysis is the cornerstone for identifying when a trader should actually buy the stock. Knowing when to buy is imperative for day traders. No matter how great the asset you may be considering, buying the asset at the wrong time could result in an enormous loss. Conversely, a bad share purchased at the right time could prove highly profitable. Technical analysis allows you to determine the best time to buy an option you are considering. Effective technical analysis enables traders to follow the way the price trends for a given stock. As discussed in Chapter 2, prices trend upward and downward over time. Technical analysis assumes that price trends are repetitive over time. Through technical analysis, these trends can be plotted using charts. The plots illustrate a security's patterns, which traders analyze to determine what has happened with the company with the listed shares over time. These charts reflect invaluable information regarding a given security's volume, price, and time. Charts can include pertinent information for day traders, such as changes in the supply and demand for a given stock and how market forces will impact the company's future supply and demand. This information allows traders to make more informed decisions regarding their trades. Why is technical analysis important? Technical analysis is the study of the past in order to forecast the future. Traders review past market data for price trends and patterns, then use that data to make decisions on what stock to buy. It's important to note that, although forecasting is an aspect of technical analysis is not used as a tool for day traders to predict the financial markets. Forecasting is applied to a given security's price movement as a method of projecting the direction of future trends. Day traders who are able to pinpoint a charted trend are better able to forecast how the price will likely trend in the future until an expected event occurs and creates a new trend for the security. Technical analysis makes this possible. Because technical analysts rely so heavily on charts, they are called chartists. The charts used in technical analysis may look like simple graphs to the inexperienced eye, but they contain a wealth of valuable information for traders, including trending data for a security's price and volume, as well as the security's past patterns. Price patterns reflected on the chart can include information pertaining to a given security's trend lines, technical indicators, resistance, moving averages, support, and candlestick patterns, i.e. reversals. Charts that illustrate a security's pattern contain a singular element imperative to technical analysis, a basic bar. This bar scales a particular security's high, low, open, and closing on the market for a given day. Generally, most financial markets generate a new bar each day, which is how many traders reference a trading day. So when you hear traders referencing the bar at the market, they're not talking about your local pub. In most markets, a large chart will display a collection of bars that reflect all of the different high, low, open, and closing prices for a given day. It's not unusual to also find a plot illustrating the volume for each bar underneath as well. The volume plotted on the graph offers more relevant data for traders to base their trading decisions on. Quote, "The basic bar shows how price changed during the day, but adding volume information tells the other part of the story. How much of a security was demanded at that price." End quote. Dummies, 2016. When demand trends upward, it's an indication that more individuals are interested in the respective security and, thus, are willing to pay a higher price for it. Hence, the price charted on the bar informs traders about what the market is already aware of, while the volume charted on the bar tells traders just how many people know about the stock. Assumptions in technical analysis. Although both fundamental analysis and technical analysis are core principles of day trading, most traders tend to rely more heavily on one than the other when making their trading decisions. Large banks and brokerages are amongst those who actually do use both, but most traders prefer one over the other. Fundamental analysis can be applied on both microeconomic and macroeconomic levels. Micro-level fundamental analysis covers studying aspects like cost earnings, revenues, capital structure, assets and liabilities, and soft elements, i.e. competitive position. Macro-level fundamental analysis includes studying and/or forecasting a security's, quote, economic growth, inflation, credit cycles, interest rate trends, capital flows between countries, labor and resource utilization and their cyclicality, demographic trends, central bank and political policies and behavior, geopolitical matters, consumer and business trends, and soft data. Examples, sentiment or confidence surveys. End quote. Source, Technical Analysis for Day Trading, Tutorial Indicators and Examples, no date determined. Traders who rely more heavily on technical analysis enjoy two specific beliefs regarding its methodology. 1. Market cyclicality. Market activity is similar to human nature. Both have behavioral characteristics that form patterns, both engage in patterns that tend to repeat themselves, and market participants are prone to repetitive behavior because of the collective natures of the pattern. While the exact sequence of events isn't repeated perfectly, they are similar enough to denote patterns. For technical analysis, these patterns yield charts reflecting both short and long-term price behavior. Long-term price behavior is derived from the notion that business cycles are intrinsically inclined to repeat themselves in the long run. Short-term price behaviors can reflect varying trends, such as a brief price drop followed by a huge price increase. However, the security can still yield long-term growth. The implied notion of repetitive behavior also implies that trends can be identified by studying past price and volume intelligence to forecast the price direction in the future. Traders who are able to identify repetitive opportunities can also identify trade options presenting favorable odds that the rewards are worth the risk. 2. Price, volume, and volatility run in distinct trends. Price movement isn't sporadic or illogical, but rather in accordance with trends that have basis and are able to be forecasted. Research and chart data allows traders to examine these trends and, thus, study the historical behavior patterns of a stock's pricing, volume, and volatility. 3. Price and the market discounts everything. Technical analysis relies on the assumption that market price has already taken the economy, financials, and the market as a whole into account, so there's no need to examine each factor individually. Those who prefer technical analysis over fundamental analysis generally find fundamental analysis unnecessary because of all the information yielded from fundamental analysis is already reflected in market price. Technical analysis maintains its focus on pinpointing price trends and the demand of market participants for certain information. Characteristics of technical analysis. As is usually the case with the introduction of new technology, the introduction of computers to the stock market led to significant improvements for how traders apply technical analysis. Prior to the computer revolution, technical analysis typically involved traders analyzing an option's price magnitude, volume data, and successive flow through a stock ticker. Computers allowed the data to be consolidated into the chart form that traders rely on today for technical analysis. As previously mentioned, chart patterns in the basic bar are elemental points for reference for technical analysis. Moving averages, price correlations, and regression analysis have also been standard references for conducting technical analysis in the past, but the rise of technical indicators has also given rise to charting software available for traders for their technical analysis needs. All it takes for such analysis is understanding the coding knowledge to transform charted price and volume data into specific indicators of interest. Analytical approaches. There are generally two main approaches used by traders to examine stock. 1. Top-down approach, which involves analyzing a security broadly first, then from a more specific angle. Traders usually start from a major trading index, such as the S&P 500, and then get more specific by examining weekly or hourly charts for a given security. The security's moving average is examined, quote, in a more general to specific time frame, such as starting by looking at daily averages and then moving to examining hourly averages for a given stock's price movements. End quote. Traders, 2019. 2. Bottom-up approach. This involves searching for suspected undervalued securities, then examining them to determine the best time to buy, when the stock expects to bottom out. Stocks trending against the financial market's overall trend are sought out by traders. Then traders determine entry or exit points that will allow them to maximize their profits. Types of charts. There are a number of charts available for traders to use for technical analysis data. Candlestick charts, the most common and perhaps simplest of approaches available. These charts reflect a security's price history along with supply and demand over a given period. They supply the differential between the price of a given stock at opening versus closing along with the day's total range. The candlestick body reflects the price while the candlestick wick represents the daily range. Open, high, low, close charts, also referred to as bar charts as previously discussed. These charts are similar to candlestick charts, but the body of the candle is replaced with horizontal tick marks. Opening price tick mark points in the direction of the left to indicate that the data is derived from the past. Other price tick marks point to the right. Line chart. Plots data points and then connects them with a line, usually indicative of the market closing price for a given period of time. Area chart. This is basically a line chart that has the area underneath the line shaded to make visualizing the price movement easier. Heikin-Ashi chart. Incorporates candlesticks for the plotting medium, but relies on a distinct mathematical formula to determine price. Formulas are based on market factors, i.e., opening, closing, high, and low. Given the risk involved with trading stocks, traders should make as informed a decision as possible when deciding which securities to buy and when the best time to buy said security is. Technical analysis makes this possible. Whether you happen to be one who prefers fundamental analysis more or less, there is simply no substitute for technical analysis when it comes time to put your money where the stock is. Now that you have a plethora of guidance and tools to walk you through how technical analysis works, you're better equipped to make trading decisions that are most likely to yield returns on your investment. Chapter Summary. In this chapter, you learned why technical analysis is important to day traders, the assumptions and characteristics of technical analysis, analytical approaches to technical analysis and the types of charts used for technical analysis. In the next chapter, you will learn more about swing trading. Chapter 6. Swing Day Trading. Swing trading relies heavily on technical analysis to identify financial instruments that are likely to present optimal trading opportunities spanning anywhere from a few days to several weeks. Fundamental analysis may also be employed as well, but technical analysis is the primary of the two core principles used, as swing traders generally focus the analysis of their trading endeavors on price trends and patterns. Swing traders generally operate by holding positions over more than one singular trading session, but no longer than a few months. The aim for swing traders is to capitalize from anticipated price trends. They seek these opportunities in both somber securities and more volatile stock. Regardless of the behavior of the security, swing traders aim to correctly forecast the security's probable next price move so they can purchase shares at a good position to be held until the most opportune time to sell them for maximized profit. Understanding swing trading. Swing trading is the practice of profiting off of anticipated price moves on financial instruments. Thus, successful swing traders are able to enter positions in time to exploit price movements before seeking out the next optimal trading opportunity. Since swing traders hold their positions from day to months, they're exposed to added risks such as sudden drops in price. Because of these added risks, swing traders optimize their earnings potential by employing stop-loss plans, profit targets, and/or relying on price trends or technical indicators to inform their decisions on trading. Swing traders rely much more heavily on technical analysis than on fundamental analysis. Day trading is often synonymous with active trading, and swing trading is one of the most commonly practiced forms of active trading. Active trading also relies heavily on the application of technical analysis, as active traders typically use technical analysis to identify intermediate-term opportunities, which is the range between short and long-term opportunities. This range happens to be where swing trading is king, which is why it's one of the most popular forms of active trading. Given a significant amount of trading activity is short-term, technical analysis illuminates the patterns of the trends for swing traders while also allowing them to forecast the potential long-term growth expected for a given security. Quote, swing traders will often look for opportunities on the daily charts and may watch 1-hour or 15-minute charts to find precise entry and stop-loss points. End quote. Mitchell, 2019. Swing traders usually base their trading decisions on a set risk-reward assessment. They use technical analysis to analyze a stock's charted trends to determine the best time to enter their position and specify what their stop-loss point should be. Then, they forecast the best position for them to exit for maximum profits. For example, Trader Colette may consider two different trading options as follows. Entering a position for $1 per share that is forecasted to yield a $3 gain versus entering a position for $1 per share that is only forecasted to yield a $1 gain. The first option is more favorable for Trader Colette than the second option, so she's able to proceed with the opportunity that is more likely to be profitable. The opportunities available to a trader on any given day are as broad or as limited as the trader's ability to identify said opportunities. Swing trading offers traders a vast array of opportunities to maximize their earnings potential by extending their holdings, and thereby their risk, overnight. The key to success is utilizing proper risk-reward applications through the use of technical analysis, being able to identify the best time to enter, designating a proper stop-loss point, and exiting when you're most likely to maximize your profits. Adding swing trading to your portfolio is a great way for traders to enhance their skills and increase their prices. And given it's the most popular form of active trading, it's also one of the most common ways for day traders to swing their holdings from day to overnight. Chapter Summary. In this chapter, you learned the basics of swing trading, the pros of swing trading versus the cons, the distinctions between swing trading versus day trading. In the next chapter, you will learn how to survive as a day trader. Chapter 7. Day Trading Survival Kit. Market participants typically fall into two categories: investors and traders. Investors are the likes of Warren Buffett, while traders are like George Soros, quote, the man who broke the Bank of England in 1992, or Peter Schiff, Dr. Doom himself, who famously predicted the most recent stock market crashes that occurred in 2007 and 2010. Killian, 2019. While both investors and traders both possess the same objective of making profits on financial instruments, investors seek more long-term opportunities that often span years to decades, while traders seek shorter-term positions in which they can buy and sell within days, weeks, or months. Day traders' positions are usually held for hours, as these participants opt to buy and sell within a single day. In order to do that, day traders incorporate 6 logistics to trading stock. 6 logistics of day trading. 1. Open a brokerage account. In order to trade stock, a brokerage account for your trading capital must be established. Many online brokers, i.e. us.etrade.com, nerdwallet.com, and merrilledge.com, allow traders the ability to open a brokerage account within mere minutes. 2. Set your stock trading budget. Remain in the single digits. No matter how talented of a trader you are, you can expose yourself to excessive volatility when over 10% of your trading capital is allocated to any one individual stock. Never risk more than you can afford to lose. Don't tap into money not allocated for trading capital, such as funds for monthly expenses or your emergency fund. 3. Use your market orders and limit orders wisely. Traders have access to myriad order type options that ultimately dictate how any given trade is processed, but the most common types of orders are market orders and limit orders. Market orders allow traders to buy and sell stock expeditiously at the most optimal market price. Limit orders allow traders to buy and sell stock that's set either at or better than the trader's specific price point. Thus, a trader's buy orders will be capped at the maximum price the trader is willing to pay and will only be processed if the stock remains at or below that price. 4. Establish practice stock trading accounts. Demo and virtual trading accounts allow traders hands-on experience without the risk of losing actual capital. Paper trading allows traders to test and improve their skills before risking actual capital. Several online brokers, i.e. Interactive Brokers and TD Ameritrade, offer demo and virtual trading. 5. Set appropriate benchmarks for measuring your returns. Essential to all forms of investing, as the end goal is to remain ahead of respective benchmark index, i.e. NASDAQ or S&P 500. Quote, measuring results is key, and if a serious investor is unable to outperform the benchmark, something even pro-investors struggle to do, then it makes financial sense to invest in a low-cost index mutual fund, or EFT. End quote. Yakum, 2019. 6. Maintain your perspective. Successful traders rely on their foundation, principles, and best practices to help them identify the most advantageous market opportunities available, not sourcing out the latest hot tips or breakout stock on everyone else's radar. Maintaining your own perspective will allow you continued success throughout your career as a day trader. Keys and rules for successful trading. As expressed throughout this book, surviving as a day trader requires considerable effort. In addition to knowing the 6 logistics to successful trading, there are also 4 elemental keys traders should understand in order to survive on the market. Traders have to exhibit both anticipation and restraint, lowering their risk by taking the appropriate time and research to assess a given security, building their positions gradually, and knowing the best times to enter and exit their positions. Traders have to know how to decipher good information on a stock from hot tips often designed to manipulate the market. Traders need to choose their brokers wisely, shaping their decisions based on their own trading style, experience, and needs. Since trading involves finances, traders also need to maintain accurate records of their gains and losses for tax purposes. Having a good grasp on the above keys to success will serve you well as you progress in your career as a day trader. In addition, the following 10 rules for success will aid you on your way. 1. Maintain a trading plan. Trading plans establish written rules specifying your entry price, when to exit your position, and your overall financial management agenda. Traders can test their plans through backtesting, which reviews their trading plan against historical data to assess how viable the plan is. Successfully backtested plans may be maintained. 2. Treat your trading like the business it is. Successful trading requires treating trading as your business, be it full or part-time. Hobbies don't require commitments. Jobs yield income with little to no expenses. A business, such as day trading, requires commitment, generates income, and also incurs risk, expenses, stress, losses, taxes, and uncertainty. Traders are basically small businesses, so do the proper due diligence required to run your business successfully. 3. Technology is your friend. Technology should be used to your advantage whenever possible. Charting, backtesting, and market updates sent to your smartphones are technological advancements helping day traders enhance their earnings potentials every day. 4. Always protect your capital. Don't make unnecessary risk with your trading capital. Use the tools and resources available to you to make informed decisions with your trades. 5. Constantly study the markets. Understanding the markets and opportunities available requires constant, ongoing research. Traders must remain knowledgeable about the past and current markets in order to forecast the future anticipation of price trends. 6. Only trade what you can afford to lose. Traders should only trade with capital that is truly expendable. The risk of any given trade is losing it all, so a trader should only trade what he or she is willing to lose. 7. Utilize a fact-based trading methodology. Trading should employ fact-based research and data, not hopes or emotions. Traders are better able to identify optimal trading opportunities when they know the pertinent fact-based research regarding a given security. 8. Always use a stop-loss plan. Stop-loss plans equip traders with predefined limits to their risk on each trade. Stop-loss plans limit traders' susceptibility to loss. 9. Stop trading on time. Traders should cease all trading when they either realize they are using an ineffective trading plan or are simply operating as an ineffective trader. Ineffective trading plans are evident when traders continue to suffer much greater losses than they anticipated. This can be resolved by developing an effective trading plan before commencing with trading. Ineffective traders are those who are incapable of following their own prescribed trading plans. This may be due to poor habits, life stressors, or other external forces. This can be resolved by taking a break from trading until the issue is properly addressed and the trader is confident with resuming with an effective trading plan. 10. Keep trading in perspective. Wins and losses are both inherent aspects of day trading, but maintaining focus on the big picture will enable you to keep trading in proper perspective. Continue maintaining sound trading practices and an effective trading plan to keep your focus on trading. Chapter Summary. In this chapter, you learned the 6 logistics of day trading, keys to survival as a day trader, and the 10 rules for successful trading. Conclusion. Day trading can be a challenging yet lucrative profession. It offers such a steady stream of risk and reward that it can seem like a financial roller coaster, creating a series of thrills that culminate to fat wallets for all vested parties. However, as you are now fully aware, there is caution, consideration, research, and due diligence that goes into the art of day trading. It's not a skill that can be mastered overnight or without continuous effort. So no matter how exciting the financial markets may be portrayed in movies or other media, it takes serious effort to attain the riches that are often associated with being a successful day trader. Day trading requires a deep understanding of stocks, securities, and equities, as well as financial markets as a whole. It requires knowing the rules of the various markets as well as the core principles of trading, such as fundamental analysis versus technical analysis, and which practice best serves your needs as a trader. It involves employing a multitude of strategies to enhance your earnings potentials, such as scalping, trading range, arbitrage, and mergers and acquisitions. It requires understanding how to distinguish fact-based research from hot tips, avoiding trends and Ponzi schemes by maintaining your trading perspective and sound trading practices and a sound trading plan. It requires sourcing the most advantageous technology available, such as charts, backtesting, and real-time news updates to better inform your trading decisions. It makes you pursue the most optimal trading opportunities available on the market. Day trading is a profession that offers just as much challenge as it does profitable opportunities, so you should be prepared to take on the challenges in order to realize the rewards. Now that you have a comprehensive understanding of what it takes to be a successful day trader, we're back to the most important question you need to answer to determine your next step in your journey towards day trading success. Is day trading right for you? Do you love stock? Are you ready for the transition? Is your stop-loss plan in place? Is your transition plan in place? And does it all add up? If your answer is yes, then your next step should be clear. Success. Glossary. Acquisition. Process by which one firm purchases another firm. Algorithm. Prescribed set of instructions for a given problem. Algorithmic trading. Trading practice based on applying computerized proprietary algorithms for the basis of executing trades on financial markets. Bond. Instrument of debt sold by companies, the government, or local authorities to increase capital. Brokerage. A business or individual who serves as a conduit between stock sellers and buyers to facilitate optimized exchanges for a fee. Buy and hold. Passive investment strategy for buying financial instruments to be held long-term regardless of market trends. Capital. Financial investment in a business or financial instrument. Cash. Value of readily available liquid assets and/or value of assets that can be liquidated immediately. Chartist. Technical analyst who employ the practice of charting the historical patterns of a given financial instrument to better inform his or her trading decisions. Cyclicality. The extent to which a firm's market share price correlates to economic fluctuations. Commodity. A basic commercial good used for trading with similar goods and/or financial instruments. Discount. Information previously considered and accounted for that is factored into a financial instruments marketplace. Dow Jones or Dow Jones Industrial Average, DJLA. Arguably the best and most vastly followed financial index worldwide, which measures the stock performance of the world's 30 largest, most actively traded options. Equity. Ownership interest in a firm. Exchange. A financial marketplace for trading financial instruments such as stocks, bonds, shares, indexes, options, and commodities. Future. Term assigned to exchange contracts designated for the sale of financial instruments that have future deliverables. Forex or Forex market or FX. Financial market consisting of investors, banks, central banks, commercial firms, hedge funds, and investment management companies that allows participants to buy, sell, exchange, and speculate on options. IPO. A firm's initial public offering of public stock options. IPO. A firm's initial public offering or public stock options. Latency. The time lapsed or delayed between stock trade request and responses. Liquidity. A financial market's relative ease of ability to buy and sell financial instruments. Margin. The difference between a broker's loan residuals and the financial instrument's market value. Margin call. When adverse price movement of a given instrument leads to a demand for additional funds. Market. reference for the actual overall equity of a given market. Merger, a form of acquisition resulting in two or more companies being combined into one and the assets of all being absorbed by the associated buyer. NASDAQ, the electronic exchange for the National Association of Securities Dealers automatic quotation system that was established in 1971 and provides listings of around 5,000 common stocks. Option, the right given to a buyer to buy or sell a financial instrument at a preset price on or before a specific date that does not obligate the buyer to execute. Order, or market limit, the purchase of a financial instrument subject to specified terms. Limit order, orders placed to purchase or sell a financial instrument for a given price or better. Market order, order placed at the current market price for expedited trading. Out of the money, deep out of the money. An option that has an exercise price either substantially above, call option, or below, pull option, the market price of an underlying financial instrument. Pattern day trading, the practice of using margin accounts for day trading 4 or more financial instruments within 5 business days, given total trades exceed 6% of total activity within the 5-day period. Portfolio, a collection of trading performance. Principal, total amount of financial capital loaned to a borrower. Profit, the venue yielded from the sale of a financial instrument minus the cost of trading. Range, a specific time frame recording records of high and low prices, bids, and offers. Range-bound trading, trading strategy aimed at identifying and exploiting stocks that are trading in price channels for maximum capitalization. S&P, Standard & Poor's Index, provides a measured value of options for the largest 500 corporations on the market. Stock, common, preferred, ownerships shared of a firm. Common stock, shares representing equity ownership in a firm. Preferred stock, shares representing equity ownership in a firm that also provides claims on earnings and assets subject to liquidation. Tick, the minimum price difference fluctuation allowed for a given security, whether increase or decrease. Trend, up, down, sideways, reversal. General pricing movement for a given market. Downtrend, price movement that progresses lower over time. Sideways trend, horizontal price movement indicative of nearly equal supply and demand. Trend reversal, reversal in price movement. Uptrend, price movement that progresses higher over time. Volatility, price option variable that measures the risk of a financial instrument. Yield, return paid in the form of dividends on a financial instrument. This has been Day Trading 101, How to Day Trade, written by Aidan Botha. Narrated by Blythe Moline for Hot Ghost Productions. Copyright 2019. All rights reserved. It is not legal to reproduce, duplicate, or transmit any part of this document in either electronic means or in printed format. Recording of this publication is strictly prohibited, and any storage of this document is not allowed unless with written permission from the publisher except for the use of brief quotations in a book review.